Okay, while we're getting set up, I'll go ahead and get started. I want to welcome everyone for joining us. My name is Heather Steele. I am the marketing coordinator here at South Bay Credit Union. I wanted to go over a little bit of housekeeping for how Zoom is going to work. We ask that you please stay muted throughout the presentation. There will be time at the end for questions. During the presentation, if you happen to have questions, please feel free to use the chat box, and I'll try to get to those if we have time, if it's possible. Otherwise, we will be able to address that after at the end when we have question time. This presentation is being recorded and it will be sent out to all the participants, as well as being made available on our YouTube channel. So you can go ahead and just search South Bay Credit Union and you'll find our whole library along with this recording. I do want to introduce a few of our South Bay Credit Union mortgage team that are present on the call with us. So we have David Ellings, he's our Chief Lending Officer. Rosemarie Valdez, she is our mortgage officer. And Yvette Placencia, she is our mortgage processor. And then last but not least, I'd like to present David Cantrell. He is that face you see on the screen right now. He is with American Family Funding. And let me do a little bio on David real quick, just to give a little background on who our presenter is. Sorry, one second. Of course, it disappeared as soon as I went to say it. One moment. David, maybe do you want to give a little introduction of your background, since that's not pulling up for me, of course, as soon as I go to do it. Sorry about that. So I'll let you do your own introduction and then take it away from there.
Well, I'll tell you, the short one is I'm old fat guy that knows about money. So that's pretty much who I am. But I've been in the finance industry for over 30 years. I was a securities trader at Raymond James for many years. And then I came over and I started in the mortgage business many years ago. So I've been in finance for a very long time, and it's been pretty much my passion my whole life. I live in Southern California, and we've had a partnership with South Bay Credit Union going back even longer than I've been at American Family Funding. I know it's been a partnership going back probably 10, 15 years. It's been a great partnership. We love working with South Bay. We love helping their members out. And that's really what this, and I'll just kind of transition. That's what this presentation is about. It's about helping the members. There's a lot, especially with so much information out there, and you're hearing about interest rates and real estate and purchasing and that kind of stuff, that we just wanted to have this go over. You know, I'm a mortgage lender, American Family Funding. We've been mortgage lenders for 30 years in Southern California. But we know that people hear about what's going on, but they don't sometimes really know everything about what's going on. So I'm gonna do a presentation here. It's going to have a lot of information, and quite frankly, I'm glad that this is being recorded. I will tell you at the end of this presentation, I will put my information up there, and if you want me to send you the PowerPoint, I can. This is not something where we keep it proprietary. We want to help as many members as we can, and so if it's something that you do want to have to be able to reference, because we're going to go over a lot of stuff, and a lot of it is a little bit overwhelming, and so I just want to make sure you know that you will have access to this. I can send it to you, and at any time that you want to call me up and go over some of it or have other questions, because I know sometimes people don't like asking questions in front of everybody else, which is fine, but this is still like high school, we get it. But I'm more than happy to help you out in that area. So that's what we want to do. So with that, I'm going to go ahead and start the PowerPoint here. Here we go. So I'm just, Heather, you can see that, correct? I just want to get a quick thumbs up. We're good?
Yes, we can see it. Thank you, David.
Okay. And as we go through this, again, I will tell you that I know, putting the questions in the chat will be great. But, like I said, don't be afraid to kind of stop along the way. Like if we want to spend a little bit more time, this is your presentation. Okay, trust me, I know all about this. I made up the presentation. So this presentation is for you and the membership. So if we want to take it in a different direction, or we want to spend a little bit more time in one area, I'm totally happy to do that. We put this presentation together basically as kind of a somebody that's just coming into the home buying process, but also somebody that owns a home, that has some equity in their home, and they're kind of curious, okay, what can I do with that? How can that help? So that's kind of the way and in the presentation itself, I've done a lot. I've done hundreds of these. And so I put together kind of what most people tend to ask about. But again, every situation is different. Every person is different. So if you have other questions, please feel free to put them in there, and we'll get going on it. So we call this Brave New World because, we're entering into, especially coming out of what we've all just been through. This is going to be a brave new world for everybody. First thing that we usually talk about, or we go over, is just our strategy is to close your loan together. Again, we want to talk about your credit. We're going to talk about your financial picture, your income and ability to repay a loan, some down payment, and actually the home itself. So first thing we like to talk about is your credit. That seems to be a big topic with everybody. Everybody always has questions about credit and how it works. The first thing I will tell you is that I know that there's Credit Karma out there, and I know that you get your credit scores through some of your credit cards and those types of things, and they're fine. But understand that when it comes to those companies, they're trying to give you the best possible credit score they can. And I know that sounds weird, but we'll talk about that in a minute. But this annualcreditreport.com, you can get a free credit report every year. And you can get one from Experian, one from TransUnion, and one from Equifax. Now, they don't give you credit scores, okay, but it tells you what's on your credit. And one thing that I like about this is it protects you. It lets you know what's on your credit. So what I do is I get one free report from Experian, and then 4 months later, I get one from TransUnion, and then 4 months later, I get one from Equifax. This way, throughout the entire year, I'm protected, and I know, okay, this is what should be on my credit because it's the credit that I opened. And if something shows up there that shouldn't be, well, then I know I have to take care of this. So this is completely free, completely straightforward. Now, I believe that they do offer scores for a fee, but I would not do that. But it's more of a protection. It's something that, this way you're protected all throughout the year, protecting your credit, because credit is so important. Now, credit scoring, this is where it gets a little confusing. And listen, I've been doing this a long time and I'm still confused by it. But basically, we're talking about, credit scores range from 300 to 850. Okay. It also predicts the likelihood that your borrower will get a 90-day late notice within the next 24 months, because that, we want to make sure that people are going to be able to make payments on time. Obviously, the higher the credit score, the less chance that you're going to default, i.e. the better interest rate you will get because you are a less credit risk. When it comes to interest rates, it's all about risk. Okay. And credit scoring has no memory. The score is generated and analyzed at that point in time of where you are. What makes up our credit scores? The biggest piece is payment history. Are you making your payments on time? That's 35% of your score is, are you just making your payments on time? And then the second one is balances. How high are your balances? And now let's talk, balances are done this way. If you have a available credit of $10,000 and your balance is $5,000 or higher, that works against your credit score because it's saying you have less credit. Okay. On the other side of that coin, if you have a balance of 5,000 or less, that's actually good for your credit score, because what they're saying is, hey, this person is controlling their credit. They're understanding how it works, and they actually have a lot of credit. If you even get down below 30% of your balance, then it's really good. So somebody that talks, and I talk to people on this every day, they say, I use my credit card, but I pay it down to zero every month. That's great. That's what we want to see, because that's somebody that's using credit, but controlling it and keeping it the way it should be. The one thing you should never do, and I actually can coincidentally talk to somebody about this today, is pay your credit card down to zero and then close the account. Don't close the account. because once you close that account, you lose that credit that was available. Now, what you should do is take that credit card down to zero, put it in the junk drawer that everybody has in their kitchen with all that rubber bands and old pens and other things and notepads. Put them in there and leave it alone, because that way you still have that credit. It still works for you, and that's the better situation you want to be in. Credit history. Now, this is just how long have you had credit, right? I mean, unfortunately, those, young people coming out of school, they've only 18, 22, something like that. They don't really have a lot of credit. So that does play in it. What I tell people and what I did with my kid, I have a 23 and a 24-year-old. When they were, 19 years old, I got them a credit card and I said, use this to buy your gas and then pay it off every month. That's all you need. That's all I want you to do. Just buy your gas, pay it off every month. And they did. And they actually have very good credit scores now, because that shows that they've had credit for a while and that they're controlling it. Type of credit. And this is where, it's interesting. It's only 10% of the score, but this is where we get so confused. Okay. And this is where things get really crazy. So the first confusing part, okay, is, there's 3 credit agencies. There's Equifax, there's TransUnion, and there's Experian. And they all look at things differently. So that's why their scores are so different, and sometimes really different, because maybe one merchant reported to Experian and TransUnion, but not Equifax. And so that's where it gets confusing. But then we also have type of credit. We have installment, which is like your car payment. It's the same payment every month. You make that every month. Okay, well, that's looked at. Okay, I mean, we want to make sure you're making your payments every month. But then we have revolving. That's like a credit card where the balances go up and down because it's revolving. Well, if you're controlling that, that's much better for your credit score, because it's showing, again, back to controlling your credit and making those payments on time. So we take a person that has 2 cars, they have, and that's really, and then they have a credit card that they, pay off every month. Well, that credit score is going to be okay. But then we have another person that has 3 credit cards and 1 car payment, but they're really controlling their credit. Well, that score is going to be a lot higher. So it's just, that's why people get so confused on which score, how come my score is this, how come my score is that? And I tell people, I wish I had the answer. I wish I could tell you, but it's just still confusing to me. And now let's go back to Credit Karma and those credit cards, right? They're going to look at your credit as though it's the best one. So they're going to try and get the highest score possible. So when people come to me and they say, okay, well, I just, on Credit Karma, my credit was 740. More times than not, when I pull their credit, it's usually 720-ish. Maybe there's usually about a 20 to 25 point difference between what's on a Credit Karma and what we pull. Because again, as a mortgage lender, we want to make sure that your installment payments are good, because that's what a mortgage is. The payment's the same every month, right? Make sure you have enough for that. So that's going to be important to us. Where if you have a mortgage late, like unfortunately, maybe 3 years ago, you ran into a little bit of, forgot to make a payment or whatever it is, that's going to matter more to us than if you have a missed car payment, because that's 1 car payment. It's not a mortgage. We're like, okay, well, so that's why people look at things so differently, and that's why it can be so confusing. And then the last one, inquiries. And this is one that I deal with every day when people say, I don't want you to pull my credit because it's going to ruin my score. Well, first of all, it's only 10% of your score, right? And second of all, I know for a fact, I talk to this every time, it hits your score for about 2-3 points. It really doesn't hit your score that much. But people will argue with me all the time and say, no, somebody pulled my credit and it dropped 30 points. Well, again, let's talk about all the confusing part. What possibly could have caused that to happen? And number 2, maybe there was something else in there that happened that they didn't really realize. So inquiries don't really hit that much. And the other thing I want to talk about is the credit myth, right? And that is, and this is what I hear often, I can't buy a home, I have bad credit, okay? That cannot be further from the truth. Credit does have a place when you're talking about mortgage lending, of course. But the place where it really affects us more than anything is in the interest rate, not qualification. Okay, it's the interest rate, because again, going back to the credit scoring and the risk, it's risk that we're talking about with interest. So the better credit score you have, the lower the interest rate, because you're less of a risk than vice versa. But it's your debt to income ratio, and we'll get into that in a little bit, but it's your debt to income ratio that makes the biggest part of how much you can afford and what kind of loan we can give you. That has a much bigger play on anything, because I tell people, if I bump into somebody and they're making $1 million a month and they have a credit score of 650, I'm probably going to be able to get them a loan. Whereas if I bump into somebody and they're making $1,000 a month and they got a credit score of 800, that's going to be a little bit of a challenge, right? So the one thing I want people to take away from this more than anything is, don't think because you have bad credit or challenging credit or however that you can't buy a home. That's not the case at all. And a lot of times people, their credit isn't as bad as they think it is, right? Because, you know, when it comes down to credit, it really, for a mortgage lender, as long as you don't have a bankruptcy or a foreclosure or mortgage rates, we can usually work with a lot of people with challenging credit. And even if you do have a foreclosure and bankruptcy, we only have to wait a certain amount of time before we can start that loan process again. So, you know, we're talking about credit. And then I put this slide in here because if you have a credit issue, if something's on your credit, you know, you look on there and there's a charge on there from Macy's that you're like, I don't shop at Macy's, it's not mine. It's a lot. If that happens to you, you really should go to the credit bureaus and tell them that this is on your credit, and it shouldn't be, rather than going to Macy's. Most people would go to Macy's and say, hey, this is on here. You know, it shouldn't be. A lot of times they'll be able to help you out. But if you go to if you go to the credit bureaus, if you go to Equifax and you tell them, hey, this Macy's charge is not mine, it shouldn't be on my credit, they go to Macy's and they say, Macy's, prove to us that this should be on this credit report. And if they can't, then the bureaus will take it off. So it's a little bit better to go through this route, because they go back to and they put the proof on the vendors, rather than you calling the vendors and having that argument. So so that's why the slide is in it, because I want people to have this information. So if by chance that does come up, you have a place to go. Now, understanding your financial picture. So this is where we really kind of get into qualification and what I can afford. And this is both for, you know, if you're new to the home buying process, brand new, that's great. Or if you're trying to perhaps take access the equity in your home to maybe buy another home or buy investment property, things like that. It's still always going to come down to your financial picture and what you can afford. So this is a financial snapshot. This is kind of an interesting page that, you know, this lets us know, you know, these are your earnings, you know, you payroll, you know, you might have some dividends in there. This kind of shows us what you're making and how much you make monthly, because we're going to look at that for a monthly payment. Savings, you know, what do you have in your savings? This is, you know, for more times on a new first-time home buyer, or even somebody that's buying a home, savings is going to be, okay, what do you have for a down payment? How much do you have for that down payment? So that's why we want to know how much is in your savings. And then your obligations, you know, your credit cards, your student loan, your car loan, things like that. That shows us what your debts are. Okay. So this page is pretty straightforward, you know, and there's not really too much wiggle room in this area, because, you know, this is going to be your payroll. Whether, you know, and if you get a raise, that's great, but it's going to be your payroll. You know, your savings, you're always going to be trying to add to as much as we can, but we know the world, you know, is getting more and more expensive. And then your obligations, you know, these are things that people need. But this next page, the spending, right? The spending, how much to Target, Starbucks, cable, Uber, all this kind of stuff. You know, are there areas here that we can maybe, okay, do I really need that Starbucks every day? Do I really need the Uber Eats every day? I've never done Uber Eats. I'm an old guy. I don't know how to do that stuff. You know, Home Depot, I mean, how much am I really spending at Home Depot? So are these things that if I'm a first-time home buyer and I'm not really, you know, I have a problem with my down payment, well, how much, if I take a couple of these out and put them in my savings area, how quickly can I get a little bit of a bigger down payment, right? So that's something that I love this page, because it's like, I've told people that I've been on a diet for the last 25 years, as most people in America. And they always tell you, well, if you write everything down that you're eating, you can see how, you know, why you're overweight. Well, I write everything down and I'm still overweight, but at least I know why I'm over. Well, this is the why. Why can't I save for down payment? Well, this is where if you start keeping track of things, you start really taking a look at it. You can say, hey, this is the area where I might want to, start maybe moving some of those areas into trying to save a little bit more money. Or the same thing, if you're trying to think about, buying that second home or buying something like that, is there areas here where you can put more of a down payment down? So these pages are pretty, interesting, especially if you take a hard look at them to really show exactly where your money is going to make those decisions. So building your foundation is, like we talked about, your income. So these are the things that we're going to want to take a look at when it comes time to start the qualification process or pre-approval. If you own a home and we're trying to get investor property or a second home, it's basically we're going to be doing the qualification. If you've never bought a home and we're doing this for the first time, it's we do a pre-approval. And I'll just for 1 second, I'll get into the weeds a little bit, because people will hear two terms. They will hear pre-approval, but they will also hear pre-qualification. I'm going to tell you my definition. My definition is pre-qualification is you and I having a phone conversation and you telling me, I make about this much, I have about this much in my debt, and I got about this much in my savings for down payment. What can I afford? And I would tell you, well, based on those figures, which I'm not verifying at all, I would say, yeah, you can probably afford about this. That's a pre-qualification and really doesn't do anybody any good, because today's world, if you're going to go see a property, you have to have an actual pre-approval in your hand. Pre-approval, that's where you send me your pay stubs, you send me your bank statements, you send me your taxes, we run your credit. So that way I can really delve a little bit deeper in and verify everything. So that way, when it comes time when I say, you know what, you are pre-approved for this, we can stand behind that 100%. So you'll hear both terms, but the question that you want to ask is, or if somebody is saying you're pre-approved for this and you didn't send them any information or you didn't send them any documentation, that's not a pre-approval. That's pre-qualification, and it's not going to, and when it comes time to start looking for homes, it's not going to really help you, because realtors nowadays, in the world of COVID that we are living in, you have to have a pre-approval in your hand before you can go to an open house. So you want to get a pre-approval done. So again, what are we looking for here? Your income, your stability. That's why we look at the 2 years of taxes and your W-2s, because we just want to see that history. If you're self-employed, we're going to need to see the business taxes as well, because we got to make sure that your business doesn't have any declining income, because your income is based off of your business. And then also we have stability, overtime, and bonuses. So the way overtime and bonuses work, we have to see that for an extended period of time. It's usually 18 months. So I got to see that if you're going to say, yeah, I'm making $5,000 a month, but I get another $1,200 a month in overtime every month, well, I'm going to say, okay, that's great, but you got to show me that has been consistent for about 18 months. And the same thing with bonuses. Like if you get a bonus at the end of the year as part of your, that's fine. I got to see that this year, and I got to see it the year before, and I got to see that it's pretty stable. Now, debt to income ratio. This is probably one of the most important things we look at when we're looking at qualification, because it shows if you can afford to make that payment. And what is the debt to income ratio made up of? Is exactly that, your debts and your income, your debt over your income. So if somebody was to have maybe $10,000 a month in income, we look at the allowable percentages. Is 38% on what we call the front end and 45% on what we call the back end. Okay, your front end is your allowable for housing payment, principal and interest, taxes, and we call it PITI. So that's what that 38 is. And it's for somebody making 10,000, we can allow a payment basically of $3,800 for your housing. Your total, your back end, is your total allowable debt. So now we're averaging in not just the housing payment, but your total debt, your car payments, your credit card payments, your student loan payments, your, all of the payments and all of your obligations. Back to that screen that had the obligations. So on that, we don't want to see that to be more than 45%. Nowadays, we can kind of stretch that to maybe 48, 49%. But basically, that's what those numbers are. So we tend to look at that 45% the most, because that's making sure you can afford not only your house payment, but your life payment. Now, people look at that and they say, whoa, that doesn't seem like very much. Keep in mind that we use gross income, not your take home. Okay. So, that gives a little bit more. So, all of that stuff that comes out of your paycheck, we don't factor that in. We go by just what your gross income is. So it's actually a little bit higher than a lot of people would think. But that's one of the biggest areas of qualification that we're talking about. So kind of going back to what I said about the credit, even somebody that doesn't have great credit, that just means you're going to pay a little bit higher interest rate and does not really have much to do with the qualification. This is where your qualification is, on how much debt you have and how much income you have. And that's why I tell people all the time, especially for new homeowners or new purchasers, let's do a pre-approval. When we do a pre-approval, I gather all that information and I tell you, okay, you're pre-approved for this number. If that number is good for you, then great. If it's not, if you're saying, wow, that's really, I thought I want to really kind of get a little bit higher, I can say, okay, now let's go to our debt to income and say, okay, what do we need to do to get either more income or less debt, right? How do we work that? How do we figure that out? So that's when we have those conversations of, okay, do you have a little bit more for a down payment? What's your saving? And then we go back to those, are you spending, can you maybe cut a little bit of that spending to get a little bit bigger down payment? So that's where we really kind of delve into things. And with the pre-approval, I tell you, if you're not where you want to be, I can put you on the path to get there. And so many times, so many people say, well, I think I can afford this. I might be able to afford that. But if you don't really know, then you don't have a plan. And once you get that plan, it's a world of difference, because now okay, this is what I got to save every month to get to where I want to be. And when you have that number, it's like, listen, I got to save an extra, $600 a month. So in a year and a half, I'll have enough of a down payment and I will cut my debts down to where I can. Now that you have that number, it's a lot easier to get there rather than, I think I need to save this, but I don't know. And that's not what we want. We want to have that plan, right? And this is how you get there, through knowing what is required, but then having the pre-approval to know where you stand. So now you know what's required and you know where you stand. So that's why I beg people all the time, get a pre-approval done. And again, I'm happy to do them. I do them all the time. It doesn't take that long. Once I get the information, it usually takes about 24 to 48 hours to get it back to you. It's really simply, really easily done. Doesn't cost you anything. It's free. Right there. That should be a reason. And every time I do this, I get maybe one or two people calling me for a pre-approval. But please, if it's not me, get it done somewhere, because it's so, so important for you to have it done. So now let's look at a couple of analysis and why, in my opinion, right now is one of the best times in our history to either buy a home or invest in real estate. Typical rent for single family. Oh boy. With that, I'm going to take a sip of coffee. Typical rent for a single family residence in and around Southern California, about $3,000 to $3,800 a month. I got two scenarios here. One is FHA, one is conventional. So I'm going to run through these numbers a little bit quick, but again, if we can stop if you want, or you can have this presentation to go over them, but just so you know. So we're looking at, sale price about $550,000, rate around 3%. That's pretty much where purchase rates are right about now. With an FHA loan, you only have to put down 3.5%. Okay, so sale price is $550,000. Loan amount is going to be $530, $750. Trust me on the math. I did it a couple times. So your principal and interest. Okay, your principal and interest is pretty straightforward. You just take your loan amount and you divide it by your interest rate, and then also the pay down of what your principal is. So your principal of this $2,237 is going to be about $910 a month. Your interest is going to be about $1,326. Now, the reason why I put that in there is because, principal and interest, if you're in a 30-year fixed, your payment is going to stay the same. But what happens with principal and interest is that at the beginning of the loan, you're going to be paying more in interest than you are in principal. And then as that loan goes over time, once you hit 15 years, it's about the same. And then it starts going the other way, where now you're paying more in principal and less in interest. And the reason for that is, as a lender, we tend to make sure that we get that interest paid before the principal is paid. But that's kind of the breakdown. And also your mortgage interest, and the other reason why we break this out, is tax deductible. Okay, so so you can, on your mortgage interest, that's how much each month you can be writing off. And once you have a home, this is all sent to you by your lender, so you know exactly when you go to your tax preparer, you can tell them this is how much I paid in mortgage interest. Your taxes, your property taxes. Everybody has property taxes everywhere you go. This number of 572, we estimate your property taxes to be about 1.25%. That seems to be pretty close around Southern California. Some places maybe 1%, some places maybe 1.3 or so. And part of that also is, when you voted yes to that bond for school manufacturing or school upgrades, that gets put in your property taxes. So, like I said, some areas might be a little bit more, but 1.25 seems to be pretty close. So you just take the 1.25% on the sale price. We divide that by 12. That's how you get that number. Also, property taxes, again, tax deductible. Your insurance, you have to have insurance. You got to insure the property against fire and damage. Now, you don't have to have earthquake insurance. I would suggest it. You don't have to have it, okay? But again, we use a rate of about 0.35%. Again, seems to be pretty close. And then on FHA, you got to pay mortgage insurance. Okay. Anytime you pay less than 20%, you have to pay mortgage insurance, but we'll talk about that more when we're talking about conventional. Mortgage insurance on FHA, you have to pay for the life of the loan. So as long as you have an FHA loan, you're going to be paying mortgage insurance. Different than conventional. I'll talk about that in a moment. But I just want people to know, I don't want you thinking that, oh, well, you know what? I don't want to have to pay mortgage insurance. I don't want to do an FHA loan. I don't want to buy a house. No. It's always better to buy a house than rent. Always, always better. Because look, I will show you your principal and interest payment, $3,341. Well, that's pretty much what rent is anyway. But then when you start taking off the taxes of what you can write off, that number comes your real after tax number is about $2,700, right? So it's always better. Even in FHA, it's always better to buy rather than rent, even if you have to pay mortgage insurance, because what will happen is at some point in time, and I've done this plenty of times, people will come to me and say, I have an FHA loan, but I have 20% equity in the property. What do I do? And I'm like, okay, well, now what we'll do is we'll move you into a conventional loan, get you out of that FHA loan, and get rid of the mortgage insurance. So that's, so even if somebody is paying the same rate or even a little bit more in rate, you're going to be getting rid of a pretty big monthly part of your payment, right? So that's something that I always think is a good idea. So there's renting, there's FHA, and then there's conventional. Let's talk about conventional. So conventional, same, we're going to do the same, 550. Conventional might be a little bit higher interest rate, because FHA does have a little bit lower rates, but we're still in a very low rate environment. So even and we're going to put 5% down. So you're putting a little bit more down. So your loan amount, a little bit less. Here we go. PITI again, this one, principal, here's your interest. Taxes are going to be about the same because it's based on basically the same loan amount. But notice how your mortgage insurance is a little bit less, right? Because in a conventional mortgage, again, anytime you're putting down less than 20%, you have to pay mortgage insurance, but it is tiered. And what I mean by that is if you're putting 5% down, like in this example, you have to pay $225. And credit does come into play on this. That is true. Your higher credit score will be better for mortgage insurance than a lower credit score. But there's plenty of mortgage insurance companies out there, and some of them have better rates for lower credit, and some have better rates for higher credit. So we would find the best rate for you. But if you're putting 10% down, this number is probably going to be $175. If you're putting 15% down, it might be $100, so it does vary. And then in a conventional loan, once you hit that 20% equity position in your property, you don't have to refinance out of it. All you do is you call up your servicer, and by servicer, that's whoever's sending you your statements, okay? Whoever sends you your statements, you call them up and you say, hey, I think I'm at 20% equity in my property. I'd like the mortgage insurance to be removed. They will tell you, okay, you have to get an appraisal to prove to us that your equity is there, because what they'll do is they'll say, okay, this is how much you owe. This is what your property is valued at. It's called loan to value, your loan to your value. And if that loan to value is at 80% or lower, they automatically remove the mortgage insurance, which is great because that way you don't have to do a refinance out of one loan into another loan. It's just, hey, I'm going to go ahead and get rid of this. Now, when I'm talking to people about which loan product to use, it really does come down to how much you have for a down payment, right? And if you're in that 3.5%, then great. Then we'll use FHA and it'll be wonderful. If you can come up with 5% or more, I would probably be looking more to the conventional side of it, because that way you don't have to deal with getting the refinancing to get rid of that mortgage insurance. And it's the same thing if you're again buying that second home or that investment property. You have to put for investment properties and you have to put 25% down. So that's something that we'd have to look at and see if there's enough equity in your home to maybe do that, but we'll talk about that in a little bit. But anyway, let's go back. Even on a conventional loan where you're paying a little bit more in interest rate, once you take out the taxes, look at what your actual payment is. That's $1,700. I mean, that's, compared to what renting is, that's fantastic. So I definitely would, when you talk about renting, and I know I know the struggle of so many people, and I come across so many people, and it breaks my heart that they're paying this much in rent, and that's causing them not to be able to have enough of a down payment because so much is going to rent that they can't save. And I trust me, I hear you, and I wish I could change it. Unfortunately, that's just the world that we live in an area where home prices are a little bit higher. But remember, you don't have to have 20%, right? You can have 3.5%. I mean, 3.5% down, sometimes we can pull that off, and that way we get you in that FHA. And then once you start having that appreciation, that's when things really start changing. So again, it's not, the myth of I got to put 20% down couldn't be further from the truth. Could not be further from the truth, really. Let's look at what if we wait. Right? If you're in that position where you're like, well, I want to wait and see if rates are going to go down, or maybe prices are going to come down, or I just need a little bit more. Let's take a look at that. So here again, we're back to the 550 at 3%. Our loan amount, we're putting 20% down on these, all right, just for lack of, so we don't have the mortgage insurance. But here we go. So we got principal and interest with about 1855. Same calculations with the principal and interest. Your taxes, again, the same thing. We did that 1.25%. Your insurance, and here is your property taxes. So this is 550 at 3%. Okay. Now, what if I wait? What if I say, you know what? I think prices are coming down. I'm going to wait. What if they don't? Right? What if prices go up? And they have been going up recently. Interest rates started to tick up a little bit. Let's look at that situation. So now our sale price just went up $50,000, which is not a lot in the real estate world. Interest rate going up to 4%. That might be a little aggressive, but you know what? At the beginning of 2020, before COVID hit before it really started affecting us in March, interest rates were about 4%. So it really wasn't that long ago that this was the interest rate. Loan amount still putting 20% down, but look what happens. Our PITI, our principal, the amount we're sending to principal now goes down because remember we're getting more interest than we were. We get the more interest. Taxes go up a little bit. Insurance also goes up. Our PITI now is here. It's a $500 difference, for just this, which really is not that much. $500 a month difference. So I tell people right now, don't wait. It just doesn't make sense to wait to possibly have, even $200 a month. I mean, it adds up quick if you're waiting. So I would, prices are so high, I'm going to wait for them to come down. They're not going to come down. I'm here to tell you that the reason why prices are so high is strictly supply and demand. And there is just very, very, very low supply right now because we don't have enough homes built in this country. When 2008, 2009 happened and we went through that, the recession, builders stopped building. And so now that things are starting to, turn around a little bit, I know we would just go through COVID, but even that, we're now coming out of that too. I got pre-approvals all over my desk for people that can't find a home, so if you're in that situation where you can either buy that, buy that first home or even invest in real estate, now's the time to do it. The most important thing is interest rates. Interest rates being where they are now, historically low, possibly never this low again. That's the biggest factor, not so much the price as much as the interest rate, because this is what you're paying over 30 years, right? So, and again, look at how much of a difference this makes for just a $50,000 difference in a point in interest. So I would definitely be moving more towards purchasing than not. But we talked a little bit about this, the best loan program with FHA. VA, we'll talk about that for just half a second. VA is great loan, great loan. If there are any veterans out there, first of all, thank you for your service. Second of all, this is one of the ways we thank you, is you can buy a property with no money down. There is no down payment, and you don't pay mortgage insurance either. Now, you do have to pay closing costs. Okay, so it's not like it's completely zero, but most of the time you can either use lender credits, or there's certain things that maybe the seller can credit you where you can get those closing costs down quite a bit. So VA loans are wonderful, wonderful loans. I wish more veterans either one knew about them, or number two would use them, because they're great. And a quick real myth about this one is some people think you can only use it once. That's not true. The way that it works is you can only have one VA loan at a time, meaning you're in a VA loan, right? But now you're going to go purchase another home. You're going to sell this home. You can sell this home, use your VA loan for the new loan, right? So you can only have one VA loan going at a time. It's not that you can only use it once. And then USDA loans, again, 100% financing, nothing down. But these you have to live in an area that is zoned as rural. So Bakersfield, up into Fresno, up into, outside of the LA area, outside, kind of getting out into those rural areas that you have to actually live. It has to be zoned as rural. You can't even be like, hey, I'm out in the middle of nowhere. If it's not zoned that way, you can't use it. But if it is, then it is a loan program that we can use. And then the other ones, the conforming conventional. Conforming conventional right now is basically any loan amount that's below $548,000. It's 548 and change, because the government can't do anything with a round number on it. Even 548, it can't be 550, it's got to be 548. So any loan amount below 548. And remember, it's loan amount, not purchase price. Right. So if you're buying a place that's even $600,000 and you're putting 5% down, you're going to be in that conforming area, because it's the loan amount that counts, not the sale price. Jumbo loans are anything over $847,000, I think it is. Now, again, 847 can't be a round number. Now, wait a second. There's a gap between those two, right? Well, in the LA area in Southern California, we actually have 3 levels of loans. We have conforming, anything over 548, but below that 860, whatever it was. That's what we call high balance. Okay, so it's called high balance conforming. So it's still a conforming loan, but not quite to that jumbo area. And the real difference, and again, getting too much into the weeds, the real difference is that most lenders in this country, us included, sell our loans to Fannie Mae and Freddie Mac, which are the government-backed agencies that basically hold a huge amount of our mortgage debt in our country. So they buy loans, they buy conforming loans, and they buy the high balance loans. Once you get into jumbo loans, now you're talking about investors. So it's like the bigger banks or investment companies or things like that. They're the ones that are actually purchasing those mortgages. And so that's why jumbo, the qualifications get a little bit different, because each investor might be a little bit different. So you just have to find out which ones we're going to be dealing with and look at their qualifications. But conforming and even high balance, those qualifications are pretty much the same. And then we have fixed rate versus adjustable rate. And look, there's interest only. That's not really around much anymore, to be honest with you, because interest rates are so low. Interest only is not really part of the discussion. And then even in the fixed rate versus adjustable rate, a lot of people immediately say, I don't want adjustable rate, I want that fixed rate. And right now I get it, because rates are so low, that kind of makes sense that, because back when rates were, even 5-6%, you would get a 30-year fixed at, let's say, 5.5. And I know right now that sounds crazy, but trust me, that's not that bad of a rate. But then your adjustable rate might be around 3%, right? And the way adjustable rates work is there are basically three types. There's a what's called a 5-1 ARM, adjustable rate mortgage, 7-1 ARM, and 10-1 ARM. And what that means is on the 5-1, your rate stays fixed for 5 years, and then in year 6, it adjusts. It starts to adjust to whatever the rate is at that time. 7 years stays fixed for 7 years and then adjusts. 10 years stays fixed for 10 years and then adjusts. Now, again, they're good products for people that come to me and they say, you know what, this is going to be my starter home. We're planning on living here, 5 to 6 years, and then we're probably going to sell this and move into something else. Well, that's where I'm like, well, let's take a look at the adjustable rate because it stays fixed for 7 years. It's going to be a little bit less than the fixed rate is now. So you're going to be saving a little bit of money. And if you know you're going to be selling it or wanting to move on, it's not a bad thing to take a look at. Because again, there are situations where, I'm going to be living here for 7 years and then I'm moving to wherever, wherever they're going to end up moving. But so I'm not saying that they're great for everybody. And I'm not saying that it's better than a fixed rate. It's not, because fixed rate, if you can get nowadays, especially with rates where they are, you can really get a great fixed rate. But don't shy away from it. It's not a bad discussion to have, right? Because even if you can pay, $100, $150 less a month for 6 years, that ends up being quite a bit of money. And then if you're going to move. Also, the one thing about adjustable rates is there are caps on them, right? So it's not like they can go to the moon. There's usually, it's called a 2 and a 5. So you have a 2% cap, meaning that your interest rate can only move 2% in any 1 year, right? So if you start at a 3% adjustable rate, and then in 5 years rates are at 7, your rate can only go up to 5% because it can only go up 2 points at a time. It can go down 2, which is possible. And then the next time that comes around, you're paying 5% now and rates are at 8%. Well, it can still only move 2%. So you're still only going to go up to 7%. And then there's a lifetime cap. That's what the 5 is. It can only go up 5% for the life of the loan. So if you start at 3, the most you could ever possibly pay is 8. And again, I know people say 8%. What are you talking about? That's crazy. Hey, I bought my house 20 years ago and I was paying 11%. And I thought I was brilliant because my parents were paying 18%, so I don't think rates are going that high. I don't really, even in the long term. But, again, for the discussion of which product is best for you, we can have that discussion. It's not something we should just shy away from because it might work better for you. So that's a discussion. And that's why, lenders, that we should look at the whole thing, not just, be so focused on, hey, this is the fixed rate. That's the only way we want to go. There are other options out there. Millennials. Now I know this slide's a little bit busy. I get it, but the reason why I put this on here is I kind of go back to the why wait, because these millennials, they're coming, whether we like it or not, they are coming. And trust me, my kids are millennials. I know they're on their way. And when you look at, the thing that's really, important about this slide is look at this. 30% of millennials are living with a parent. How long do you think that's going to last? And this is only from 2009, 2013. This number is probably quite a bit higher right now. They're coming into the marketplace, right? And so why are prices so high? Supply and demand. Well, don't you think the demand of this age group is going to be huge? These guys are bigger than the baby boomers were. So, if you're thinking about possibly, buying a home but you might want to wait, again, don't wait. Please don't wait. Get a pre-approval done. Let's figure out how we can help you out, because with this whole huge group coming, it's going to cause, I know builders are building now, which is great, but it's going to be tough to catch up to where we are now with this huge group coming up behind us. And then this is kind of a situation where a lot of people will say, you know what, hey, I got 60% equity in my home. Now what? Nobody knows what to do with it, right? A lot of people are happy they got all that equity in their home, but they don't know how to use it. That's one of the areas of, our society where people, it's great that you have that much equity, but nobody really talks about, well, what next? Well, that's why you come talk to me, because what I'll tell you is, hey, let's use some of that money instead of just having it sit there as equity in your home, doing nothing for you. Let's put that to work, right? And this is just one quick scenario where, your home is valued at 450. You got $250,000 in, which means you owe. You've been paying on your home, so you owe 200,000, but it's worth 450. So you got $250,000 of equity in that home. Well, maybe you think about buying another home. So this home is at 350. Your cost of to get into it is 20 grand. Your purchase price is going to be 370. Now, if you take a home loan of $200,000, you probably don't even need that much, because quite frankly, if you do $90,000, that's enough to cover the 20% down and the cost of the loan. You get a $90,000 loan, you can have another home. And now you rent this thing out. All of a sudden, now you have rental income, right? And now talking about, all right, that's kind of how we're starting to build wealth, right? It's taking the equity we have in our home now and putting that to work. I've been telling people to refinance, pull out $50,000, put it in a mutual fund and leave it alone for 15 years. Because I guarantee you're going to you have to remember, the return on your investment when you talk about home ownership is whatever the interest rate is, right? So if you leave that equity in your home or you refinance down to 3%, your return on that investment is 3%. But let's say you refinance and you pull out $50,000, you're paying 3% for that money. I understand that, but you invest that in a mutual fund. Most mutual funds, the big guys, the Fidelities, the Drivers, the Putnams, those guys, historically, the return on that investment is usually 8-9%, right? So let's say even 8%. You're paying 3%, you're making 8%, you're making 5% for nothing, rather than having that equity just sit in your home, not doing anything for you, right? So this is the time, with interest rates where they are right now, where we can do what the major huge corporations have been doing for years, which is borrowing inexpensive money and investing it somewhere else to grow their company or grow their worth. That's what we have with interest rates where they are. That's what we can do. Even if they move up a little bit, even at 3.5, even let's say it's 4%, you're still making 8%. You're still making 4% for nothing, right? So instead, and I know that people have told us, I want to pay off my house. I want to pay off my house. And I understand that. But I think part of that might come from our parents and our grandparents who wanted to pay off their house. Well, their home cost them $150,000 and they were paying 13% in interest. Well, yeah, I'd want to pay that off too, but that's not the world we're living in right now. We're living in a very low interest rate market, which means the cost of funds are very, very low. This is this is a situation we really can start looking at, hey, let's see if we can't put some of that money to work and help grow our wealth, either through more, buying another home, which is a fantastic idea, or again, maybe if you only have enough equity to pull a little bit out, then fine, then just invest that somewhere else and make that money back. Make that money work for you rather than just sitting there not doing anything for you. So, and then completing the mortgage loan process is, that's when we start doing all the processing and all the underwriting and that's how we get you into a home. So here's my information. I'm going to leave this up here just for a second or two. Or actually more than a second or two. It's just, unfortunately, you got to look at my picture, which, sorry about that. But if anybody has any questions, I'd be more than happy. Again, if you want to take this information down, so you can either email me, call me if you want to have a little bit more in-depth conversation, or if you want this presentation, just email me. Hey, can you shoot me I was on the South Bay call. Can you shoot me the presentation? Happy to do it. But right now, like I said, if anybody has any questions, you want to go back to a slide, look at something a little bit more in depth or something along those lines, I'm happy to do that. Anybody?
Didn't look like any questions came through on the chat, but if anybody has any questions, feel free to unmute yourself or ask for permission. We'll wait a few more minutes.
Anybody? Am I that thorough? I guess so.
It was very good, David. Looks like we do have one question. Any update on the Biden down payment support?
So I don't know. I don't know. I mean, being that this just kind of came through, but I'll tell you, when it comes to down payment assistance, usually this is the challenge that we have. And thank you for that question. I should have brought that up because a lot of people ask about down payment assistance. When it comes to down payment assistance, typically there are income restrictions on being able to use down payment assistance. Meaning, I think right now for a single person, you can only make up to 70, I want to say 78,000. And I think for a married couple, it's like 130,000, which again, sounds like a great amount of money. And that's wonderful. The challenge comes in that if you're making, and I don't like being Debbie Downer here, but if you're making $78,000, qualifying for a $600,000 mortgage is a little tough. So down payment assistance programs work fantastic in Boise, Idaho, where homes are $250,000. But in our area, they can be a little bit of a challenge. Now, some of we have a loan officer that works in the Palm Springs area. And I know that they've used them a couple of times because now you're getting out of that Inland Empire and prices are a little bit lower. So if you're getting out to areas where prices are a little bit lower, like, even, Palmdale, Lancaster, a little bit further out, or Riverside County, or somewhere like where you're getting a little bit further out from the suburbs, and you get into that, 300, 350 range, then they're available and can be used. But I'm in Valencia, California, and so San Fernando Valley, Santa Clarita Valley, usually homes here are a little bit higher. And I'll be completely, I've never used one. Because I just haven't had that opportunity, because there's just so much of a difference between the only income that you're allowed to use, but then being able to qualify on that debt to income that we talked about earlier. So that's usually where, but the down payment assistance programs are usually handled through the counties. So if you go to either LA County, Riverside County, Orange County, if you go onto those websites and you start delving into it a little bit, you can see what the qualifications are. And then what would happen if you found a place and you were able to use it and qualify, the county and the lender would work together to use those programs. And the way that they work, just to let you know, there's usually two types of programs. Number one is a grant, where they just say, yeah, you know what, we're in favor of home ownership. We're going to grant you, and it's usually like up to 3% of the sale price is what they'll grant you for closing costs and down payment assistance. The other thing that they'll do, and it's again still 3%, they'll loan you that money. Right? Let's again, I'll just use a number, $25,000, and then what they do is they put that loan on we call it a silent second. It's on the back, and I know it sounds silly, but it's on the back end of the loan. So when you refinance and or sell that property, that's when you pay that loan back, right? So if you never sell, then fine, you don't ever have to pay it back. But if you either sell or refinance, that's when they have to pay that loan back. So those are usually the two ways that the down payment assistance works. But again, it's usually handled more through the counties rather than the actual lender. Now, there are some lenders out there that say they have first-time home buyer programs, and we're a little bit guilty of that too. But for us, what that basically means is we have licenses to use the FHA program. There's some lenders out there that don't, that they can't, they just don't have the qualifications to use the FHA. There's some lenders out there that'll give you, 5-10 grand towards your closing costs, and that's great. And again, like I said, we're wonderful here, but there are other lenders out there. So there might be that situation, but for the most part, especially nowadays, it's pretty much, down payment. Down payment right now, unfortunately, is the biggest hurdle to home ownership that I've run into. I see a question. How long does a pre-approval last? So our pre-approvals, we make them good for 90 days. The reason why we do 90 days is because when we pull your credit, that's good for 120 days. And we want to make sure that we have a little bit of a cushion there. If I do a pre-approval for you and we get it all done and I say you're pre-approved for $600,000, if you can't find anything in 90 days, you call me up and you say, you know what, this thing's about to expire. I'll say, well, has anything really changed? And you're going to be very forthright and say, no, nothing's changed at all. And I'm going to say, okay, shoot me a new bank statement, shoot me new pay stubs, and I'll send you out a new pre-approval. So, it's just updating that information. So getting another pre-approval it's not like we have to go through the whole process again. We just make sure that the income and the savings are the same, and then we can just send out another one and, make it good for another 90 days. But most places are about 90 days for the most part. So.
David, we did have another question come through in the Q&A.
Yep.
It says, if they rent in the South Bay, would it be wise to buy outside of the area, such as like Palm Springs, since it's cheaper, and use that as rental property to get some of the tax benefits / tax cuts?
Okay, so if I rent in South Bay, would it be wise to buy in Palm Springs since it's cheaper, and then using that as a rental property? Oh, okay. So you want to buy in, so you're going to continue renting in South Bay, but buy a property in Palm Springs and rent that property out. Yeah, sure. That's a good idea. But now, okay, between us 17 people, let me tell you what I would do. I would go out and I would say that Palm Springs property is my primary residence. Because when it's your primary residence, now we're talking back into the FHA or 5% down. If it's a rental property or investment property, you have to put 25% down. So I would say, hey, go out there, buy that as your primary residence. And then you say, you know what? Why did I want to live in Palm Springs when I have a great place out in South Bay? I'm gonna go ahead and move back there, but I'm gonna then rent this place out. That would probably be the situation that I would suggest, because if you buy as a primary residence, it's not like we're the primary residence police and we're going to come out there and say, are you still living here as a primary resident? Once you get that transaction done, I would then, like I said, just kind of keep your rental and as you're going through the process, but buy that as your primary. Now, if you own a place already, you cannot, unless you're saying I'm selling this place and buying another place as a primary residence. You can't have two primary residences. So, if you own a place, then you have to buy that as a rental. Now, again, let's take a look at this. If you're not against moving around a little bit, owning a place, and then saying, you know what, I am going to move, that's going to be my primary residence, but I'm going to rent this place out, then you can do that. That's I'm buying a primary, I'm going to keep this as a rental. But when we do that, back to that debt to income ratio, you have to be able to qualify for both payments. Both the rental pay or the payment you have on your rental property and your primary residence. Now, again, rental income, doesn't that count for anything? It does count for something as long as you have a rental agreement in place. For the first year, we give you 75% of your rent as income, meaning you're renting it out for $1,000. We'll say, okay, $750 you can count as income. But what a lot of people do when they rental properties, which is what you should be doing, is you write off everything. Right, so you have as little income as possible because you don't want to pay any taxes on it. Well, then when it comes time to qualify for another place, I can only give you the income you're telling Uncle Sam that you're making, right? So, but this is why you want to talk to an experienced lender, because there are a lot of different situations that we can come up with and a lot of different strategies and a lot of different scenarios that we can figure out to put you in the best situation possible. But back to the original question, what I would do is I would buy in Palm Springs and then just continue renting and say it's my primary residence and just continue to rent in the South Bay. Okay, first-time home buyer with retired Social Security and pension, is that difficult to work with? Not at all, not one bit, because actually Social Security and pension is pretty simple. The way we do it is we just look at your Social Security checks, and then we actually, because when you get a Social Security check, I know usually they take out I think Medicare or something else. So we call what's called grossing that up. So we put that 1.25% we were talking about before we add that back in, so you get a little bit more income. And then usually with pensions, and sometimes it can be a teeny bit of a pain, but more times not pretty easy. If you just call your pension people, they send you a letter. And when you first start your pension, it says, John Smith is going to get $550,000 or $5,500 a month forever. So once we get that letter, we use that as income. So it's just, sometimes you have to reach out to your administrator, because like Social Security, they send out that letter every year saying this is how much you're going to be this year. With pensions, it's usually only at the first time that you get that pension. But again, if you just reach out to your administrator and say, hey, I'm thinking about buying a house, can you send me my pension letter? They send it out. And then, yeah, so that's totally easy to use. Social Security and pension, no problem. Very, very easy to verify. Very, very easy to use. So it's not an issue at all. So anything else? Any more?
Last call for questions.
Oh, so again, I will say, if you want this presentation, or you want to have, please feel free to reach out to me. One of the reasons why we've been partners with South Bay so long is that we want to make sure we take care of their members. And so there's no question that I won't feel very, very, very happy answering. I'm more than happy to work with you guys and help you guys out as much as I can.
Thank you so much for everyone for attending. Again, we'll be sending out this presentation as an email to link to our website as well as our YouTube. And again, thank you for attending and have a great evening. Thank you so much, David.
No, it's my pleasure. Thank you guys. I really appreciate it.
Have a great evening. Thank you.
Bye, everybody. Oh, here's